Now let us try to construct a cash flow statement from operations together. Essentially, let us see how the adjustment process works. Imagine you owe the merchant $40, and you go to the store and buy $120 worth of stuff, and you pay only $110. How much do you owe? Let me repeat. You owed $40, you buy new $120, and you pay only $110. How much do you owe to the merchant now? Take a moment to think about it. Feel free to pause this video. Well, the answer is 50. You still owe 50. That 50 would be recorded under accounts receivable by the company. This is not accounting. This is simple logic. To make it work under a formula, think of it this way. Old receivables plus new sales minus payments leads to new receivables. Under this formulaic approach, new receivables would be 40 plus 120 minus 110 equals to 50. Logic, right? Did it make sense? I hope so. So if you know revenue and the year-on-year change in receivables, you can calculate cash payments. That is the number that appears on the cash flow statement. Let me make a more complex example, one that is exactly like this, but we will walk backwards. All right, let us work on this one. I have given you beginning receivables and ending receivables and revenues for the year. How much cash did we get paid? This is identical to the previous example with different numbers. So, how much cash is received? Think, how much? Quick logic says that if receivables increased by 25, then you must have been paid 25 less than the 100 we bought. Let us think about it as to why. Assume all 25 owed to us from last year were paid. So now we have cash of 25, and our receivables are 0. Since we sold for 100 and new receivables are 50, that means that receivables increased from 0 to 50. Therefore, only 50 of cash was received on the new sales. 50 of cash now and 25 of cash from last year's receivables. The total cash we have now in our hands is 75. The same thing can be expressed in a formula. Old receivables plus new sales minus payments leads to new receivables. Plug in the numbers, and cash received is 75. This simple formula tells us how a cash flow statement is constructed. When you look at Apple's cash flow statement or any other company's cash flow statement, all that you will see is an adjustment under cash flow statement from operations. This adjustment will be minus $25 million, which is the difference between this year's and last year's receivables. The logic is simple. If you are selling and your receivables are increasing, then it means that people did not pay you in cash. If this is the cash, when the cash is received, is necessarily less than the income you have. Again, simple logic. If you sold for 100 and the net of 25 did not pay you, then the cash that you received is 75. Let us do another example. We are again selling, but now receivables are decreasing from 40 to 20. How much cash did we receive? Think. Pause the screen. All right. The answer is we received 120 of cash. Why? Well, it is the same logic as before. This time, our receivables went down. This means that the customers paid more cash than what they actually bought. Hence, receivables went down. Think of this logically. Assume all of last year's credit holders paid. Cash received is 40, and the receivables are now 0. Now, from this year's 100 sales, 20 are the new receivables. That means the company received 18 cash. So total cash is what we got from last year's payers and this year's. 80 plus 40 equals 120. From a formula point of view, this is what we see on the cash flow statement. We see that net income is 100, but there is an adjustment of plus 20 because of the change in receivables. Hence, cash flows are 120. Let us do an example about the payable. Payables are also accruals, but are liability accruals. Let us play with this simple example. First, we see that revenues are 100. Now, my question to you is, how much of this is received in cash? Pause and think. The answer is 100. Sales of 100 are all in cash. If it was not in cash, we would have seen a receivable. There are no receivables, so it is all cash. Had there been any receivables, we would have seen them in the balance sheet. Now, the only accrual we have on the income statement relates to expenses. We see that we have 60 of wages expense. But how much of these expenses did we really pay? The answer lies in the wages payable under the balance sheet. These have to relate to the wages expense in the income statement. So if expenses are 60, how much cash did you pay? Pause and think. Well, you owed your employees 15 to start. Now they worked for you for another 60 more. So the total you owe them now is 75. We see that by the end of the period, we owe them only 25. If total work is 75 and we owe them 25, that means we have paid them 50. Given that cash received from revenues is 100, then our total cash for the period is 100 cash received and 50 paid, for a net of 50. From a formulaic solution under the cash flow statement, all you see is net income and the change in payables. If you are running a business and your payable balance is growing, that means you have more cash than income. This is simple logic. Expenses reduce income. But if there is no cash outflow, then cash does not go down, and it is higher than income. Let us make another example with different numbers. This time I put a general payables and the general expense. It can be any expense and any payable related to that expense. Think of telephone expense and payables, marketing expense and payable, R&D expense and payable. It can be anything. Now in this example, you have expenses of 60 and payables reduce from 30 to 10. So what is cash flow from operations for the period? Pause and think. We know that cash received from sales is 100 and there are no receivables. From the expense of 60, we need to know how much it was paid in cash. Since payables go down, that means we paid more than our 60 of expenses. Specifically, payables went down by 20. That means we paid all our expenses of 60 plus another 20 of what we owed. The total payout is 80. Cash received is 100, then the net cash is 20. From a formulaic point of view, the CFO is less than net income. Net income is 40, but we paid an extra 20 on top of our expenses. So the CFO is 40 minus 20 equals 20. As you see in this formula, when payables go down year over year, then that means we paid more cash than what it is in expenses. Therefore, CFO is less than income. Another example, this time on a depreciation accrual. Here, we see that revenues are 100, depreciation is 60, and the income is 40. So how much is the CFO? Pause and think. We know that depreciation is a non-cash expense. We buy a building 5 years ago for 100 to be used for 20 years. The depreciation per year on a straight line basis is 5 per year. Now, if I register depreciation expense for that building today, does that mean we paid $5 today? No, not at all. The building was paid for 5 years ago. We're simply making an accounting entry. Depreciation is always a non-cash expense. So to arrive to cash, we always start with that income, which is a 40, and add back the depreciation, which is a 60, to arrive to the CFO, which is 100. Easy, huh?